The rise and fall of Barings Bank. A story of power, profit, and peril. Barings Bank, founded in 1762, once stood as one of the most prestigious and respected financial institutions in the world. Known as the Queen's Bank, it was a powerhouse in global finance, trusted by royalty, governments, and wealthy elites alike. However, the bank's reputation and fortune met a dramatic end in 1995 due to the reckless actions of one rogue trader. This is the story of Barings Bank's rise to prominence and its rapid descent into insolvency, a cautionary tale of risk, ambition, and the volatile nature of global finance. The beginnings. From humble roots to aristocratic favor, Barings was founded in London by German-born brothers Francis and John Baring. The bank started as a family-owned business with a modest aim of supporting trade and investment in England's expanding empire. However, Barings soon demonstrated a keen understanding of international trade and finance, establishing itself as a trusted partner for European monarchs and British aristocracy. The bank's exceptional track record and reliable reputation attracted clients such as the British royal family, cementing its place as a critical institution in global finance. In the 19th century, Barings expanded its operations worldwide, financing key projects in the United States and Latin America. It became instrumental in funding critical infrastructure, including the Erie Canal and major railroads in the U.S. Barings' global reach allowed it to influence major geopolitical events, helping governments and businesses navigate the complex world of international finance. A bank for the world. Global expansion and influence. Barings reached the height of its power in the late 19th century when it held an unrivaled position in finance and diplomacy. The bank helped broker deals and provide capital to growing economies around the world, becoming a trusted advisor to government officials and private enterprises alike. The institution's international presence and strong leadership made it one of the first global banks, pioneering strategies that helped set the foundations for modern financial practices. By the early 20th century, Barings had become a respected institution that weathered world wars, economic downturns, and social upheavals. It thrived during times of global prosperity and survived challenges during periods of instability, developing a deep expertise in risk management and international trade. Barings Bank was admired for its commitment to maintaining financial integrity and trusted partnerships, an image that remained intact for more than 200 years. The decline begins. Risk and overconfidence. By the late 20th century, Barings Bank's culture began to shift. The bank's emphasis on tradition and security was increasingly overshadowed by a growing desire for aggressive expansion and high-stakes investments. This new direction was fueled by the pressures of a rapidly evolving global economy, where competition was fierce, and financial markets were becoming more complex. This shift in culture led to a more relaxed attitude toward risk oversight and management. In the 1990s, the bank ventured heavily into derivatives trading, a high-risk investment strategy that was poorly understood at the time. This new realm of finance, while potentially profitable, required strict controls and vigilant oversight to mitigate losses. Yet, Barings underestimated the need for risk management in this area, a mistake that would soon prove catastrophic. The rogue trader. Nick Leeson and the collapse. In 1992, Barings appointed Nick Leeson, a young trader, to head the bank's operations in Singapore. Leeson was tasked with executing relatively low-risk trades on behalf of clients and the bank. However, unsupervised and emboldened by initial successes, Leeson began to make unauthorized trades, placing risky bets on the Japanese stock market. Using complex financial derivatives, he concealed these speculative trades in a hidden account. Initially, Leeson's gambles appeared profitable, which encouraged him to take even larger risks. However, in 1995, a series of adverse market events led to massive losses. The Kobe earthquake in January 1995 destabilized the Japanese market, causing Leeson's speculative bets to spiral out of control. By the time his losses were uncovered, Barings Bank was in debt to the tune of £827 million, equivalent to over $1 billion today, a sum that exceeded the bank's available capital. The fall of Barings Bank. Legacy and lessons. The revelation of Barings' financial predicament sent shockwaves throughout the global financial community. Despite desperate efforts to raise funds and rescue the institution, the scale of Leeson's losses left Barings Bank bankrupt. In February 1995, after more than 2 centuries of success, the bank was forced into administration and subsequently acquired by ING, a Dutch financial conglomerate, for the symbolic sum of £1. Barings Bank's fall highlighted critical flaws in risk management and corporate oversight within the banking industry. It illustrated the dangers of unregulated financial speculation and underscored the need for checks and balances in financial institutions. The scandal also sparked regulatory reforms across global financial markets to improve transparency, oversight, and control. The aftermath and enduring impact. While Barings Bank ceased to exist as an independent entity, its legacy continues to shape the world of finance. The downfall of such a prestigious institution led to new regulatory practices aimed at preventing similar collapses, emphasizing the importance of strong internal controls and a cautious approach to risk. Today, Nick Leeson's story serves as a cautionary tale for banks and businesses worldwide, reminding the financial industry of the need for vigilance and accountability. Barings Bank's journey, from a modest family enterprise to a global financial titan and, finally, to a bankrupt relic, reveals both the possibilities and perils within the world of high finance. The bank's dramatic rise and fall underscore an age-old truth. Success in finance requires not only innovation and ambition but also prudence, transparency, and a firm grasp of risk.